Hi, Harry Dent here. For people who normally listen to us at our free newsletter, Economy and Markets, or our paid monthly, Boom and Bust, you'll notice that those are gone. Our publisher, Charles Street Publishing, a division of Agora that has a whole array of newsletters, decided to stop publishing us. That's their decision. No problem with that. But they did transition everybody onto a new newsletter and a whole new set of things without mentioning that we were gone. I'll leave that up to you whether you think that was a good way to do that or not. But for people just to know, we do have our free newsletter. It's called Harry's Take and Rodney's Take now. Is available at harrydent.com. You can sign up for that for free. Later in this month, we're going to republish under our original name, HS Dent Forecast, as well as a newsletter from Rodney, which you'll be able to subscribe to at an introductory rate. But go to harrydent.com and so you can really keep up with us. Obviously, a lot is going on. I've been warning that these viruses, almost 2 weeks ago, that they were going to peter out quicker than people thought. 200,000 deaths. Did we do everything perfect? Now I'm seeing 40,000, 60,000 max. So that's the reason the markets are rebounding. And this rebound is probably about over. And we're talking about that on harrydent.com in the free newsletter. But today I want to mention something really important. Gold. Now, I don't hate gold, but I'm not a gold bug. And our sister newsletters at Agora were largely gold bug oriented. I see gold as an inflation hedge, not a deflation hedge. And I think, with this rally now, which I've been supporting for a long time. I mean, I thought it bottomed at 1,050 in late 2015, saw it rallying to at least 1,400. And when it got a little past there, I said, you know what? Looks like it's going farther. A good short-term analyst, Steve Miller at AskSlim.com, had a target of 1720. I felt like that was very reasonable, even 1,800. Andy Pancholi, who's my co-author of Zero Hour at MarketTimingReport.com, he is seeing something very interesting. First of all, strong turn point for gold here, and he's seeing strong resistance right near where AskSlim.com was saying that the big target for gold was just over 1,700. Now, you got to notice recently, gold has been on a tear. Why? We just saw heaven for gold. Central banks, particularly the Federal Reserve, unlimited money printing, $5 trillion repo credit line to banks. And now they're buying everything, not just T-bills, but treasury bonds and asset-backed mortgages. And they're going to buy junk, and they're buying junk bonds and corporate bonds. They can buy everything like Japan and probably eventually stop. So of course gold likes that. Gold's been on a tear. Such a tear that you can't even hardly buy physical gold. And gold's physical gold, spot gold's been outrunning the GLD, the ETF that I track more. And recently, Google searches the highest ever for gold. Now, I don't have to tell smart people here. When people are that bullish, it's usually a contrary sign, a sign that things are getting ready to top. And you would ask, why would gold top here? Everything in its favor. This money printing is not going to stop. This virus is receding, but there's going to be huge repercussion. We all know now for months. I'll tell you why it could. As soon as Andy told me this, I'm like, I can see it. I remember 2008, and this is how gold behaves. In 2008, when the economy slowed down, gold rallied into that at first because they sensed money printing and stimulus. And they love money printing because down the road, that means inflation to them. Well, what they didn't see was Lehman Brothers going down and a sudden deflationary collapse, a sudden downturn in the economy that started to look like a depression. And depression means deflation. Gold is a stellar inflation hedge. It was the best hedge among many commodities, but the best in the 1970s inflationary recession, what I call the summer season. We're in the winter season and the worst of it's about to come. That's why I've been warning. Gold may rally, may have a bear market rally, but it's not going to new highs from what I see. And it is going to go down again to lower lows than we saw in late 2015. Maybe not much lower, because gold has, to its credit, because of its kind of crisis and intrinsic value, held up much better than most commodities. Oil's been down over 80% and going lower. Silver's been down 70% or more. Iron ore, 80%. The CRB, the broad commodity index, down 70%. Gold's only been down 45% at worst, and I see it being down maybe 50, 55%. My best target, 950 to 1,000, but worst case, 700 to 2008 lows. So I don't hate gold. I'm bearish on gold when we're in a deflationary scenario and a downturn. And again, look at this recent rally. I'm sorry, the recent crash. Gold goes up, continues going up in the first few days of that crash, and as soon as they see something more shocking, a sharp crash, suggesting a serious downturn, a deflation, gold goes down 10% or more. Gold does not prove to be the safe haven. It's still better than other commodities. It's still better than stocks. But gold is not going to be your friend in this downturn. I've been warning this for years, and I'm warning it again. So again, Andy comes up with this strong resistance here, and I'm thinking, oh, you know what gold's not seeing? Just like Lehman Brothers. Right in mid-2008, when gold, saw nothing but money printing ahead, all of a sudden Lehman Brothers goes down. Well, this virus is way worse than that. This is a sudden shutdown of the economy, much like the hurricane I went through in Puerto Rico in late 2017, where everything just shut down, dysfunctional for 3 months. Sudden shock. You know what that means? Consumer demand drops dramatically. Not 5 or 10%, not a rolling recession that builds on each other. A sudden deep freeze shock. That means deflation in prices. Consumer prices and producer prices are already deflating in March early on. They're going to deflate a lot more. We're going to be in 20% unemployment. We already have enough people lined up in the last 3 weeks for unemployment to have 14% unemployment already. It's probably going to be 20 before this shock is over. Gold's not seeing this. They're looking at the money printing, and it is massive. Gold has every right to be bullish about that. They're not seeing this shock. That's why I could see gold suddenly, right when everybody's so bullish on it, you can't even buy physical gold, that it just suddenly goes down like it did in a few months in 2008. It just went down 33% overnight. Silver went down 50. And guess what went up? What the gold bugs hate? The dollar, up 28%. So that's what I'm warning today. Now, this is not a foregone conclusion. This is a very strong resistance point for gold that most people aren't going to see. But if it can break above here this week, if it can hold here and then break above and maybe get to, higher, then it could go back to 1800, to even its old highs, 1934, maybe even higher. I think that's unlikely because, again, I think about this shock. We're going to get this very quickly now. Yeah, the virus is tailing off, but the shock is just beginning. And I think gold could react to that drastically. So I've been warning, don't look a gift horse in the mouth. Great thing for people. A lot of people on our newsletters also listen to the gold bugs. I advise against that. I'm going to give you more education on that. But I've been warning, this is not going to be your safe haven. And this is an excellent time to get out. Even if it went to 1800, my best target, or the old highs, 1934, you have a lot more downside. My minimum target is a new low at 950. My maximum target, which is higher than it used to be because gold has held up well, is 700. Do you really want to hold your gold through that? Now, if it goes there a couple of years from now, which I expect, when do I think gold will be there? Late 2022, when stocks bottom and this whole deflationary shakeout happens. Then we get a mild, not the hyperinflation of the gold bug, a mild spring season of inflation, even milder than the 40s, 50s, and 60s. And gold will enter the next commodity boom and will be a star in it. But inflation is not going to be as strong in the future. We've already seen the strongest inflation in modern history peaking in 1980. And I'll get into that more in my next newsletter coming out in May. So go to harrydent.com, get on our free newsletter to keep up with updates. I'm going to give you more than usual because of this time, and you'll have the opportunity at a special price to get on our real newsletters coming out without interruption beginning May. So again, thanks for listening, harrydent.com.